So we're going to finish up the section on fringe benefits today, and this is where we left off. So we'll get to this next slide for employer provided meals and lodging. So the value of meals furnished in kind by employers to employees may be excluded from employees' income. Employer provided meals are not subject to federal income tax withholding or Social Security, Medicare, or FUTA if the meals are furnished on the employer's business premises. They are furnished for the convenience of the employer. You know, things like, hey, you can't take a lunch today. We need you to stay in, so we're just going to provide lunch. Employer provided lodging, the value of employer provided lodging is excluded from employees' incomes as well if the lodging meets the following requirements. The lodging is furnished on the employer's business premises. The lodging is furnished for the employer's convenience, and employees are required to accept the lodging as a condition of employment. And that was pretty much the last little segment on employer provided benefits. So now we're going to jump right into advances and overpayments. Pardon me. Salary advances or prepaid wages and overpayments must be included in an employee's income for the payroll period when received and are subject to federal income tax withholding, Social Security, Medicare, and FUTA taxes at that time. The appropriate tax treatment of repaid advances or overpayments depends on the type of tax involved and when that money is repaid to the employer. If an employee repays an advance or overpayment during the same year the money was received, the employer excludes the repayment from the employee's income when reporting on the W-2. When there's federal unemployment, Social Security, and Medicare taxes, it does take a little bit of extra caution. You'll need to review for that federal unemployment wage base. And if an employee repays the advance or overpayment after the employer has filed its 941 for the quarter during which the overpayment was made, the employer must refund any over withheld Social Security and Medicare taxes to the employee after filing Form 941X and claiming a refund. A word of caution: if an employee repays an advance or overpayment in the later year and requests a refund of overpaid Social Security and Medicare taxes, the employer must take into account any applicable wage bases in the year in which the advance overpayment was made. So just, kind of keep that in the back of your mind. Because there's so much to review, I'm going to let you guys review these examples on your own since you will have the slides. Back pay awards. When an employee wins a lawsuit or settlement against their employer for alleged violations of federal and state employment laws, example like wage and hour law or labor management type suit, the amounts awarded are often considered to be back pay for wages that were originally unlawfully denied. As such, the IRS has generally ruled that they're subject to federal income tax withholding, Social Security, Medicare, and FUTA. Here's your first pop quiz. Repayments of wages from a prior year are, or would require, reissuing of a W-2, require completion of Form W-2C and 941X, can be made only if the employee has not yet filed his income tax return, or are only reported on the employee's tax return. What do we think? When an employee repays an overpayment from a prior year, the employer will adjust the prior year's Social Security and Medicare taxes using forms W-2C and 941X. So if that was your choice, you are correct. Now we'll get into some bonuses and commissions. Amounts paid to employees as bonuses in addition to their usual compensation must be included in the employee's income and are subject to federal income tax withholding, Social Security, Medicare, and FUTA. A signing bonus. The IRS has ruled bonuses paid to employees for signing a contract are wages subject to federal income tax withholding, Social Security, Medicare, and FUTA. Another item to keep in mind with those signing bonuses, if they are paid or any bonus, those may be required to be included in your blended overtime rate for an hourly employee. Contract cancellation payments. The IRS has ruled that a payment made by an employer to an employee in return for cancellation of the employee's rights under an employment contract is wages subject to federal income tax withholding, Social Security, Medicare, and FUTA. Keep that in mind. Push money exception is when a manufacturer pays a bonus to a salesperson working for a retailer, so not really working for that manufacturer, but for the retailer, getting them to push those products. The bonus is not wages because it's being paid by a third party, not the employer. However, if that push money ends up going to the manufacturer from the retailer, and the manufacturer pays that to the employee, it is then taxable for federal withholding, Social Security, Medicare, and FUTA. Commissions on sales of goods or insurance premiums are subject to federal income tax withholding, Social Security, Medicare, and FUTA when paid to the employee or former employee. Keep that in mind. Death benefits paid upon an employee's death to his or her estate or beneficiaries must be reported on Form 1099-R if they are paid under a qualified plan. Death benefits from a non-qualified plan, compensation plan, must be reported on 1099 MISC to the estate or beneficiary. Disaster relief payments. Gross income does not include any amount received by an individual as a qualified disaster payment. The term qualified disaster payment means any amount paid to or for the benefit of an individual to reimburse or pay reasonable and unnecessary personal, family, living, funeral expenses as incurred resulting from the disaster, to reimburse or pay reasonable and necessary expenses incurred for the repair or rehabilitation of a personal residence, paid by a federal, state, or local government in connection to the qualified disaster, or to promote the general welfare. Qualified disaster includes a disaster resulting from a terrorist or military action, a presidentially declared disaster, a disaster resulting from any event the Secretary of Treasury determines to be of catastrophic nature, a disaster determined by a federal, state, or local authority to warrant assistance from the federal, state, or local government. Employers' disaster relief payments may be tax-free. So here's something that, in the event that a disaster is issued, such as, like, think back historically, Hurricane Katrina, some of those types of payments, people were allowed to even pull from their 401ks. tax-free without receiving any kind of penalty. It's always something to review. Jury duty pay. The tax treatment of wages received from an employer for time an employee spends on jury duty depends on the employer's policy. If the employer pays an employee his regular wages, in addition to jury duty pay received from the government, the wages are subject to federal income tax withholding, Social Security, Medicare, and FUTA. If the employer pays the employee the difference between the two wages, only that difference is subject to federal income tax withholding, Social Security, Medicare, and FUTA. If the employer pays an employee's wages for time spent on jury duty, but requires the employee to turn over the jury duty pay to the employer, only the difference of the amount paid and the amount turned over is subject to federal income tax withholding. Leave sharing. When an employee donates a certain number of paid leave days that they have available and unused and are deposited in a leave bank, the employees who participate in the plan and have medical emergencies can then use those paid days from the bank. The wages are subject to federal income tax withholding, Social Security, Medicare, and FUTA. Retroactive wages. The retroactive wage payments are treated as wages when they are made and are subject to federal income tax withholding, Social Security, Medicare, and FUTA taxes at the current rate and under the current wage limits. The IRS has defined retroactive payments as supplemental wages. Employers may choose to withhold federal income tax using the optional flat rate or aggregate method when the employee's year-to-date supplemental wages are no more than $1 million. Taxable tips. Generally speaking, tips or gratuities provided voluntarily by customers are taxable wages to the employee receiving them. Because of the special nature of tip income, with the employee's wages being provided to a great extent by the customers rather than the employer, there are special rules that apply. Here's some helpful tips determining whether a payment is a tip or a service charge. Certain factors are used to determine whether payments constitute tips or service charges. The absence of any of the following factors creates a doubt as to whether the payment is a tip and indicate payment may be a service charge. The payment must be free from compulsion. The customer must have the restricted right to determine the amount. The payment should not be the subject of negotiations or dictated by employer policy. And generally, the customer has the right to determine who receives the payment. An employer or employee's characterization of a payment as a tip is non-determinative. Examples of service charges commonly added to a customer's check include a large dining party gratuity, a banquet event fee, cruise trip package fee, and the like. Employees must report their tip income if it's at least $20 in the month. Electronic tip reporting is accepted and follows the same guidelines as reporting on paper. The withholding on tip income, tips are subject to federal income tax, Social Security, Medicare, and FUTA. Under reported tips, the employer is only liable for its portion of FICA. Just keep that in mind. And the tip rate is determined by the IRS, so you definitely want to keep in mind any changes on each year. Loans to employees. This is an interesting one, and I did have at least one question on this on the exam. So it is kind of an interesting little calculation to kind of keep in mind. Employer loans. A de minimis loan below market value when the outstanding principal of all below market loans are made to employees does not exceed $10,000 on any day during a year. No portion of the discounted interest is subject to federal income tax, Social Security, Medicare, or FUTA. When determining if that $10,000 daily limit has been reached, the total of all loans between the employer and the employee must be combined. The below market loans exceeding $10,000, if the total loan balance exceeds $10,000 on any day, the difference between the interest charged by the employer and the IRS rate of interest is subject to Social Security, Medicare, and FUTA. Federal income tax withholding is not required. Forgiven loans and employee relocation loans. Special provisions when a loan is made in relocation to the employer's relocation to the employee. No additional income results if the loan is secured by a mortgage on the new principal residence acquired in connection with that transfer or relocation. Forgiven loans. Any loan forgiven by the employer is considered compensation to the employee and is then subject to federal income tax withholding, federal employment taxes at the time the loan is forgiven. Loan to exercise non-statutory stock option, where an employer loans employee to an employee at the applicable federal interest rate to purchase employer stock pursuant to an exercise of non-statutory stock option, and then reduces the principal of the loan when the stock's value declines. The amount of the reduction in principal is compensation income to the employee. The income is then wages and is subject to federal income tax withholding, Social Security, Medicare, and FUTA. Pop quiz. An employee was given a below market loan of $17,000. The current IRS interest rate is 9%, and the employer charges 7% interest. Calculate the income to be added to the employee's W-2. You selected 340, you're correct. Under the IRS rules, when an employee has loans provided by the employer in excess of $10,000, the employer must impute interest to the employee's income if the interest rate the employee pays is less than the applicable federal interest rate. So there you have it. Sick leave pay. Sick leave pay is one of the more vexing payroll issues, and the proper tax treatment of sick pay is difficult. Sick pay can take many forms, but its essential purpose is to replace the wages of an employee who cannot work because of a non-job related illness or injury. The proper tax treatment of such payments depends on several variables, including who makes the payments, who bears the insurance risk, who paid the premiums on any insurance involved, if the employee pays the premiums, or whether they were paid before or after taxes. Most employers provide their employees with paid sick leave or sick days, the payments are generally taxable to federal income tax withholding, Social Security, Medicare, and FUTA when paid. But you always want to make sure if it's under a separate plan or is it within the employee's typical wages. Payments made by the employer where the employer sick pay plan is self-insured, the employer bears the risk, the insurance risk, and the employer makes the payments. Payments made by an employer's agent is where the employer contracts with a third party to administer its disability plan and pays that third party on a cost-free basis while retaining the insurance payments made to disabled employees made by that third party are treated as if they are made by the employer. Payments made by a third party who is not an agent, where the employer contracts with a third party insurer to make those disability payments to its employees, and that third party bears the risk of insuring the employees. It assumes a greater role in the area of tax responsibility. Pop quiz. If a third-party sick pay is reported on W-2 under the name and federal ID number of the employer, who's responsible for reporting Form 8922? We didn't necessarily cover that, but it's going to 8922 is the reconciliation to the W-2. So if the employer is filing that W-2, who files the reconciliation to go with that filing to the IRS? The insurer is the correct answer. The insurer is responsible for filing Form 8922, the third-party sick pay recap, when third-party sick pay is reported on the W-2 under the name and federal ID number of that employer. Form 8922 provides the IRS the ability to reconcile the difference between Forms W-2 and 941 when the employer and third-party sick pay provider share that responsibility for reporting. The reporting responsibility or the responsibility for reporting income and employment taxes withheld and deposited depends on the sick pay agreement who made the payments to the employees. If the employer makes the payment, the employer must report all taxable amounts on its quarterly 941. The taxable amounts also must be reported on the employee's W-2, and all payments must be recorded on Form 940. If the employer's agent makes the payments, generally the employer retains the responsibility for reporting disability payments under that employer's name, and federal ID number should be used on all forms. However, if the agency agreement shifts the responsibility from the employer to the agent should use its own name and federal ID number on reporting forms. If a third-party insurer makes payments, both the employer and the third party have reporting responsibilities. If the third party does not properly transfer the liability for the employer's portion of Social Security, Medicare, and FUTA to the employer, it becomes liable for the employer's portion. It must report the taxable amount of sick pay on its quarterly 941, line 2. The taxable amounts must also be reported by the third party to the employee on the W-2. We're going to get into some silly stock options now. The option to buy stock of a company at favorable price with favorable tax treatment can take several forms, including incentive stock options, employee stock purchase plans, or non-qualified stock options. A stock option is an offer by an employee to sell shares of its stock to employees at a specific price. The contract between the employee and the company will generally specify a period of time over which the option can be exercised, or a stock is purchased at the set price, and may have a vesting schedule associated with the exercise of those options. The vesting schedule identifies how quickly an employee will be eligible to purchase company stock. Income tax withholding is not required when an individual exercises a statutory stock option because no income is recognized at the time of the exercise. I'm not going to read the glossary of items for you, but these are definitely terms you're going to want to know so that you understand what those stock options mean. Stock awards. If an employer pays employees with company stock instead of cash as compensation for services rendered, the fair market value of the stock when transferred to the employee without restriction is wages and subject to federal income tax withholding, Social Security, Medicare, and FUTA. Restricted stock is discriminatory in that it usually is provided to the highly compensated employees. Restricted stock is subject to Social Security, Medicare, and FUTA in the year the employee performs the related services or when substantial risk of forfeiture ends, whichever is later. Pardon me. Here's your pop quiz. What election do employers make when they choose fair market value of stock included in income before the stock has been vested? The option is A. Employees can make an 83B election, which allows the employee the ability to elect to include income of the fair market value of the stock at the time of election. Workers' compensation is a form of insurance that employers are generally required to buy to insulate them against lawsuits brought by employees who are hurt or ill while become ill while working. Payments received as workers' compensation benefits are not included in an employee's gross income and are not subject to any employment taxes. This exemption applies only to amounts received as compensation for injuries or illness suffered on the job, and only to the benefits that do not exceed the benefit provided under the applicable state or federal workers' compensation law. This exclusion is not limited to benefits paid by a state workers' comp agency but may include some employer payments. See, that's most often in the public sector. To be excluded, the payments must be made under a federal, state, or local law or regulations issued by a political subdivision, such as sewer district or school board, that in the nature of a workers' compensation act. This exclusion only applies to federal income and FUTA taxes, however, not Social Security and Medicare. Dependent care assistance. Many employers now provide some type of dependent care assistance programs to their employees, whether it's on-site, off-site, or an off-site daycare facility, or a reimbursement to the employee's expenses in obtaining their own dependent care. Amounts spent by the employer on behalf of employees under a dependent care assistance program are excluded from the employee's income and are not subject to federal income tax, withholding, Social Security, Medicare, or FUTA under the following exclusions or limitations. The dependent care must be necessary. For the income exclusion to apply, the eligible expenses in the dependent care assistance program must pay for or provide services that are necessary so the employee receiving the benefit can work. Also, the dependent must be a child under age 13 or another dependent who cannot care for him or herself. An employer's dependent care expenses are treated as incurred when the care is provided, not when the payments are made to that employee or to a third party. The dependent care assistance program must be a written plan. It must be separate and designated solely for the employee's benefit. The program must not discriminate in favor of highly compensated employees in terms of the contribution, benefit, or eligibility. No more than 25% of the assistance provided during the year may benefit shareholders or owners owning more than 5% interest. Eligible employees must receive reasonable notification of the availability and terms of the program. And the employer must provide a written statement each year by January 31st, showing the dependent care expenses incurred by the employer for the previous year. Can be reported on W-2 for that purpose. Box 10 would show that. Severance pay, which is provided to the employees because they were terminated, must be included in that terminated employee's income, is subject to federal income tax withholding, Social Security, Medicare, and FUTA. These amounts are subject to taxation as a supplemental wage when they were paid to the employees. Payments made under severance plans are not considered non-qualified deferred compensation. The entire amount of the payment cannot exceed 2 times the employee's annual compensation for the year preceding in which the employee's separation from service is. The arrangement requires that all payments must be made no later than the end of the second calendar year following the year in which the employee terminates service. Separations due to participation in a window program are treated under the same arrangement with respect to involuntary separations from service. Under a window program, certain groups of employees are identified as being subject to separation from service, and the employer provides an incentive for them to voluntarily separate from service, a buyout. A golden parachute is when companies change ownership, and key executives are often provided with a golden parachute to soften their landing should they be terminated by the new employer. The IRC contains special rules governing the taxation of these payments. A parachute payment is a compensation paid to an officer, shareholder, or highly compensated employee only after a change in corporate ownership or control that is at least 3 times the employee's average compensation during the 5 most recent years. An excess parachute payment is the portion of the parachute payment that exceeds the employee's 5-year average income or compensation. Golden parachute is typically, when you see it, you'll see these large amounts over $1 million. And I always picture that as truly like this fantastic golden parachute helping, those higher ups land on their feet or retire typically. Club memberships may be provided to employees who use the club for both business and personal reasons. In essence, the employer can exclude club dues or payments or reimbursements from an employee's income to the extent they're business related, and the employee substantiates the business portion of them. What's a club? Country clubs, golf clubs, athletic clubs, airline clubs, and the like. The employer can exclude those club dues from an employee's income as long as they're business related and the employee can substantiate them. An employer can avoid the deduction disallowance by treating the employer paid club dues as employee compensation if they choose to do this. Adoption assistance. This amount does change every year, so that's another thing you'll want to keep watch of. The IRC code number 137 excludes from an employee's income the employer provided adoption assistance furnished under an adoption assistance program in connection with the employee's adoption of an eligible child. The maximum exclusion for qualified adoption expenses in 2020 is $14,300 per eligible child over all taxable years related to the particular adoption. The limitation is not applied on an annual basis. It is just for that year. The maximum exclusion includes amounts connected with an unsuccessful attempt to adopt a child before successfully finalizing the adoption. The $14,300 limitation applies to both married individuals and unmarried individuals adopting an eligible child. An unmarried couple seeking to adopt an eligible child must apply the dollar limitation to the couple's combined qualified adoption expense. There is income limitation on this. The amount excluded from gross income is phased out for individuals with modified adjusted gross income of more than $214,520 and is totally lost to individuals with a modified adjusted income of at least $254,520. So that's an item to keep a watch of too. Differential military payment. Compensation paid to employees while on military duty that represents the difference between the employee's regular pay and pay provided by the state or federal government is referred to as differential military pay. Think of those individuals who are in the National Guard when they leave for their 2 weeks a year or every other weekend type thing. You'll want to know how to properly tax that item. And it is handled differently when those armed service members are transferred into a combat zone versus just doing their every other weekend. Pop quiz. All of the following benefits are taxable except on-premises athletic facilities, an incentive sales award, reimbursement for meal expenses incurred during relocation, company paid premiums for $1 million or $100,000 in employee group term life. All the following are taxable except on-premises athletic facilities. Under the IRS rule, the employee's use of on-premises athletic facilities is excluded from income. Payment of meal expenses during a move, employee group term life insurance in excess of $50,000, and incentive awards are taxable income. Ta-da, we made it, guys. We made it through the week and through fringe benefits.
Okay, I had one question on commissions.
Okay.
So what are commissions taxable for? Is it federal income and Social Security and Medicare and FUTA? Or does it, because I had written down that it excluded FUTA, but I don't know why.
Well, and it, it would depend on with that FUTA, where are they at with their wage base? And I'm getting to it so I can read you the specific ruling.
Okay. Yeah, commissions paid to them are not subject to federal income tax withholding, but are subject to FICA and FUTA if the salesperson is only paid by commission. Does that sound right?
So here's the ruling. Commissions on sales of goods or insurance premiums are subject to federal income tax withholding, Social Security, Medicare, and FUTA taxes when paid to an employee or former employee entitled to deferred or renewal commissions. This is true whether or not the employee was directly involved in selling the products. Full-time life insurance salespeople can be governed or are governed by special rules applicable to statutory employees. Commissions paid to them are not subject to federal income tax withholding, but they are subject to Social Security and Medicare taxes. The commissions are excluded from wages for FUTA purposes only if the salesperson is paid solely by commission. So that's probably where you got that from. If they are a solely commission person, they are not subject to FUTA.
Okay, thank you.
Sure.
I know I'm the one who wrote that slide, and I'm still like, what did I say?
Anything else?
I think that was my only question. I did notice on the very next slide, after the bonuses and commission slide, it says 700 instead of 7,000 as the wage base. So I think it just for FUTA, if an employee is under the wage base of 7,000, then refund the FUTA, or then refund on FUTA can be claimed on a 941. So that was just a mistype.
I didn't get there.
Slide 39.
Yeah, I don't know why I don't see the numbers, but
I don't know. Anyway.
Yeah. I don't see it.
That's okay. The next one. Keep going one more. No, maybe not. I don't know.
I know, because this is the only one that mentions commission.
And then the next one is, oh no, I got it out of order. Advances and overpayments.
Let's see, then it must be this way.
There you go. So yeah, instead of 700, it should be
yep, I see at the top there.
Yeah. Okay.
Okay, well, Kalisha, I hope you have a good time at your little spa weekend.
Thank you.
You're welcome.
You guys all have a happy Valentine's Day too.
Great.
Thanks. All right.
Thanks. Okay, we'll see you next week then, and happy Friday.
Yeah.
Yay.
Thank you.
Thank you.
Bye.
Bye.
Bye.